Okay, now we come to interest. And we look at interest expense and we say, okay, what's the most important driver of how much interest the firm pays? Well, we pay interest on our debt. So the firm pays interest on total debt. And so what we need to do is take our interest expense as a function, again, of the previous year's total debt. Because what I want to say is, again, just like with depreciation, I'm going to have depreciation that is, or I'm going to have interest expense only on my previous year's debt, and this is just interest-bearing debt, and not on my current year's debt. In other words, I might increase my debt, and so then the following year I'd have an increase in interest. Okay? So we'll take the absolute value. Again, here interest expense is a negative value, and this is going to be a function of the previous year's total debt. And we have two debt items here in 2013. I have this long-term debt, and I have an item called newly issued debt. Oh, I did something wrong here. What did I do? Oh, I forgot to include the other debt on the balance sheet, which is short-term debt. Right? So what I'm looking for here is all my interest-bearing debt, and of course I've denoted it all as debt and left one out. So now when I do my calculation, I get the appropriate percentage. So these are all the debt instruments in the previous year that I'm paying interest on. And so when I calculate my future interest, it will be on new debt, the new debt amounts in the future year. Now, interest income. Interest income is any interest that I earn on savings account that the firm has. And that means the firm could be keeping its cash in a savings account and earning interest on that cash. And in fact, the firm is keeping cash. It's keeping all of its excess cash in a savings account rather than its operating cash, right? So it's using its operating cash, but it's keeping its excess cash in a savings account. Again, I'm earning interest income only on the previous year's excess cash. That's what was in the savings account. So I'll take my interest income in 2014, divide that by my excess cash in 2013, and I get the percentage of interest income. Now, the last thing here is non-operating income. This is any income that I'm earning from a non-operating asset. So this could be as simple as some equity that the firm owns, and in fact, we see that the firm has equity investments. And so the firm might own some equity, and my non-operating income could be dividends from that equity. Now, our expectation is that because the firm is not involved in making equity investments, that we're not going to be involved in predicting increases in non-operating income unless we have a historical trend of that. So what we'll do is we'll keep our non-operating income growth steady, and we'll keep it steady at its historical growth rate, which has been 33.33%. So I'll keep that level steady. Now, even though I'm not predicting an increase in equity holdings, I am predicting an increase in the income from those equity holdings, and that's, again, if we think about it, that's because we expect dividends to continue to go up for the equity holdings. We expect that the firm whose equity we hold will continue to increase their dividend payout. So now we come back here to calculate our line items. We're going to calculate interest expense as a function of total debt. And so total debt in 2014 will form the forecast for our interest payments in 2015. And I want that to be a negative number. So we see that our interest expense goes down slightly, which makes sense. Our short-term debt goes down slightly. Long-term debt stays the same. We expect to pay a slightly lower interest cost. Our interest income is a function of our excess cash in 2014. So here's our forecast ratio for interest income. We multiply that times our excess cash in the previous year. And because excess cash went down, we see that interest income goes down. We're only keeping $60 in the bank. We're only going to make $3 in interest. Our non-operating income is just a simple growth rate. So we'll multiply last year times 1 plus the growth rate, and that'll give me this year. And then earnings before taxes is the sum of my operating profit and all of my non-operating items. Now that leaves me at income taxes. Now remember, income taxes is a result, it's not an input. So our tax rates are over here. They're going to be the same unless we have some inkling that they should change somehow. We're going to calculate our tax rate as a percentage of our statutory rate, and we do that calculation below. So we'll start out by equating by looking at our operating taxes, then moving from our operating taxes to our non-operating taxes, and finally figuring out what percentage of the statutory rate is actually paid. In other words, what is our reported taxes here? So we're going to set this equal to our EBITDA to calculate operating taxes. We'll set this is our operating tax rate, and we figured this out separately. This will give us our operating taxes, so this times this is what our operating taxes are equal to. Again, they grew because our operating income grew. Then we need to remove any non-operating items that would affect our taxes, and interest expense would allow us to reduce our reported taxes. And then interest income and non-operating income would both allow us to would both cause us to pay additional taxes above our reporting taxes. So we're going to take the net of our non-operating income here. It's going to be a negative because our interest expense outweighs our non-operating income. So we're going to have some tax savings, tax reduction from what the operating taxes is to what the reported taxes are going to be. So we multiply that by our statutory rate. That's our marginal rate. And we calculate our non-operating taxes. So our taxes, our operating taxes, will be reduced by our non-operating tax savings. And our income taxes, our reported income taxes, are now reconciled. Now remember that this income tax figure here is different than just multiplying earnings before taxes times the statutory rate. And it's different here because we notice that there's a difference in our operating tax rate. Our operating tax rate is different, lower than our statutory rate. And if we go back to the tax chapter that we just covered, you could see that this could be because some of our revenue was earned in a foreign tax jurisdiction, and so that means we had an adjustment to our statutory rate to calculate our operating tax rate. And if we earned some of this in a lower tax jurisdiction, that would reduce our operating tax rate. So that's why we're calculating our reported income taxes here separately rather than directly here. It's just going to be a percentage of our statutory rate. Now, net income is a direct result, so net income is just the sum of earnings before taxes and our taxes paid, and we calculate our net income. So now we have forecasted our 2015 income statement and tax statement, and we're ready to move on to forecasting the balance sheet. So when we're forecasting the balance sheet, we do the same thing. We're going to look at each item. We're going to try and determine what drives that item, and then we're going to calculate a forecast ratio for that item, and then use that ratio to calculate our forecast based on the historical information. And we do a little things a little differently when we're talking about working capital. And if you think back, a couple lectures ago, we talked about what are called conversions into items called days. And so when we're talking about working capital, we want to talk about we want to forecast these in terms of days sales or days cost of goods sold. So we do two things. First is we say, okay, the firm's got operating cash. What is its primary driver of operating cash? And that's going to be how much cash it needs to operate, and that's going to be determined by its size. So if you think back a couple lectures ago, we talked about how we think about dividing the cash account into operating and excess cash. And one of the ways was we just took it as 2% of revenue. And so that is a potential explanation here for why we might use revenue as a driver of operating cash. It's going to be the best predictor for what kind of cash we need. Okay. So the second thing is, so we're going to say we want the firm's operating cash to be a percentage of its revenue. And then we want to convert that into what we call a days measure. And a days measure is useful for working capital because what it says is if I divide the revenue by 365, I get the amount of revenue I earn every day, which here will be slightly less than 1. And what's interesting to me is how much operating cash do I need to have in terms of days could tell us how many days worth of revenue do I need to have on hand in order to continue operating the firm going forward. So the way I'll figure that out is I'll multiply by 365. Whoops, I put this as a percentage of the forecast and not as a percentage of the historical year. And so now we see that I need 7.6 days worth of revenue as cash on hand to keep the firm operating. Now I'm not going to forecast excess cash because we'll talk about that shortly. So I'll skip right to forecasting inventory. And again, it might make more sense to you to think about inventory in terms of days because this is how many days worth of revenue do I need to hold in inventory? How many units do I need to sell? And again, revenue is going to be is not going to be our driver for inventory here, but cost of goods sold is going to be our driver of inventory because this is going to be the best predictor for how much inventory I have on hand. So I'll take my inventory as a percentage of 2014's cost of goods sold, and I will multiply that by 365. Oh, and let me take the absolute value here so that I have a positive forecast driver instead of a negative one. And I have 182 days of cost of goods sold on hand as inventory in 2014. Now my accounts payable on the other side, this is again going to be a function of cost of goods sold. Remember, accounts payable is money that we owe for buying product that I then turn into inventory, right? So these three things are tied together. I owe my suppliers for product that I've paid for and inventory that I've already built. So I'll take my accounts payable here. Oh, let me do absolute value first. Whoops. Let me take the absolute value of my accounts payable divided by cost of goods sold times 365, and I have 81 days of accounts payable in terms of cost of goods sold. So I'm paying back my suppliers in about 81 days.